Leah, thank you for joining me, and I'm looking forward to digging into the questions with you.
Patrick is asking, what is the easiest way to invest in Bitcoin with your solo 1K?
Patrick, again, with the solo 401k, you have the ability to invest in virtually anything, and that includes cryptocurrency, Bitcoin. So if you want to invest in Bitcoin, I'm not an expert in cryptocurrency, but generally speaking, you need to open an exchange account at one of the exchanges. We do have an article with some guidance on how to do that. So you can navigate to the client portal and go to the knowledge base and just search for cryptocurrency or Bitcoin, and you'll have some guidance there. We do provide links to a couple of exchanges that allow account open in the name of the 401k. So you set up that account, you fund it with the checking account of your 401k, and then buy that Bitcoin.
Our next question is from Bernadette. She would like to know more about the Kids for 1K and Roth IRA.
Good question, Bernadette. Kids 401k and a Roth IRA. Well, if you have kids, you're not going to be setting up a solo 401k for them, because solo 401k is designed for business owners and their spouses. So if you have a child, especially minor child, then they cannot be added to the solo 401k. A grown-up child, potentially, if that child becomes your partner in the business, then they can potentially participate in the 401k as well, but not as the employee of the solo 401k. So 401k is not for the kids, but Roth IRA is a great option for your kids. If they have earned income, then you can establish self-directed Roth IRA for them. Many of our clients have done that. I've done it for my own daughter, and been helping her build her Roth IRA since she was probably 6 or 7. So it's certainly a great way to help your kids build wealth. You do want to create a strategy with your CPA. So bring your CPA into the picture as far as if your child has earned income by themselves, or if your business is paying your child. So you want to, again, create a structure with the help of your CPA, and then if they have earned income, then you can establish a self-directed Roth IRA for them, contribute and invest. I think you're muted, Leah.
Sorry about that. Ganesh is asking, what are the tax implications on gains from exits made in investments, real estate investment, syndicates like multifamily from once a solo 1K?
Ganesh, if you made an investment with your solo 401k, whether it's a syndicated investment in a multifamily or any other investment for that matter, once the investment is sold, there is really no tax implications, because the sale is inside of a tax-deferred retirement account. So you won't be taxed on any of the gains or profits. It's because it's within confines of a tax-deferred retirement vehicle, and then you can reinvest those funds freely.
Additional question from Ganesh, I'm assuming. Is there no UBIT either for the previous question?
Correct. UBIT does not apply under leveraged real estate in the solo 401k. So if you sell real estate with leverage, there will not be any taxes. However, if your 401k is engaged in a business activity, if there is a business income that is generated by your solo 401k, then UBIT tax will apply. So again, tax to your CPA, make sure you understand the implications.
Jose is asking how to add or change beneficiaries to the plan and how to properly execute it.
Jose, you didn't specify whether you have an IRA or solo 401k. So let me address both scenarios. With solo 401k, if you're our client, you can complete a beneficiary designation form that was provided to you when the plan was established. Or you can go to the client portal go to the miscellaneous forms, pull out the beneficiary form and complete that. It can be a new beneficiary, or you can change the beneficiary using the same form. You just have to indicate that this is a change. If you have an IRA, then that is done on the custodian level. So you need to contact your custodian and request a beneficiary designation form from them, and they'll you have to complete it, submit it to them, and then a beneficiary will be updated.
Ray is asking how to roll over IRA into a solo 401k.
Right, this is very simple as far as the rollover from IRA to solo 401k. Remember that Roth IRA cannot be rolled over to a solo 401k, but traditional simple SEP IRA can in fact be rolled over to a solo 401k. We do outline the process on the client portal again. So you go to the client portal, go to the setup section, then you click on the rollover, and that will give you the step-by-step instructions with the form and instructions how to complete the rollover form. So you complete that form, submit it to the IRA custodian. The check must be made payable to the solo 401k. You specify the address where the check should be mailed. Then once you receive that rollover check, you will deposit that into your solo 401k account.
Is asking, the IRS prohibition of moving lawns or cleaning by owners does not make sense to me. If those outside expenses were not paid by the LLC, there would be more cash held in the account for further distributions and taxed as ordinary income. Is there a way to get this changed?
Well, Noel, I understand that those IRS rules don't make sense to you. I agree with you. Some of the IRS rules don't make sense, but they don't care about your opinion or my opinion. So you and I, we cannot change the rules, whether we agree with them or not, whether it makes sense or not. It actually does make sense because you're a disqualified person and you can run into a conflict of interest. So providing services to the 401k or to an IRA, examples that you mentioned, mowing a lawn or cleaning properties, for example, consider it providing services, and you're a disqualified person. As disqualified person, you're not allowed to provide services to your IRA or 401k, so you have to outsource those. You're in control, so as a trustee of the solo 401k, or if you have a checkbook IRA, you're either a manager of the LLC or trustee of the trust. You get to pick who's going to do the work, who you're going to outsource this to. So just make sure it's not immediate family members. Yourself, your spouse, kids, grandkids, their spouses. But you're free to outsource. Cannot do that yourself, even if you don't get paid. That will be considered as a legal contribution to the 401k. You're not contributing cash, but you're contributing a service. Again, that is not allowed. And sorry, Noel, but IRS not going to change the rules just because you're going to express your opinion. So there is really no way of changing that. You just have to abide by the rules. Sometimes this question comes up, and when I talk to people, I use this illustration. When you're driving a vehicle, right? Most of you here who are watching or listening this have a driver's license. You're driving. So when you get in the car and you pull out of your driveway or your garage and you go on the street, you do obey traffic signals. You stay on the right side of the road. When you approach a traffic stop or a signal, red signal, you stop, right? Now, if you run on red light, the best case scenario, you're going to get a ticket and maybe get your driver's license suspended. But the worst case scenario, you're going to get killed or you're going to get somebody else killed. So those rules are there for a reason. And you're not going to say, hey, I don't like those traffic rules. Screw this car, screw my driver's license. I'm going to throw it away. I'm going to walk instead. That will be foolish. So when you drive, you embrace those rules. And my suggestion to you here, the same. You have a lot of freedom with self-directed IRA and solo 401k. a lot of freedom, right? But there are certain limitations, certain rules that you gotta abide. And my suggestion to you, rather than fighting or disputing those rules, which again you and I, we cannot change those rules, rather than doing that, you embrace those rules and just focus on what you can do, and you will succeed and you can grow your account.
Thank you, Dimitri. Carrie is asking, what forms and taxes or responsibilities should I be aware of when closing and opening accounts, such as if I am rolling over from another 401k to an IRA? Tips and info would be appreciated.
Well, Kerry, if you have an IRA and you wish to fund it with a rollover from, let's say you have a former employer 401k, then you contact this 401k company, you complete the paperwork with them, and you indicate that you're trying to do a rollover. You are doing a rollover. You're moving from 401k to an IRA. Rollover is not a taxable event, but it is a reportable event. So the custodian of the 401k that you're moving from, they're gonna take care of everything. So they'll do the reporting. You don't have to do anything. Again, just make sure that you are doing a rollover in fact and not a distribution, because if you request a distribution, that will be a taxable event. You don't want to do that. You want funds to go directly from one custodian to another.
Krista is asking, I want a better understanding of what services your annual fees cover and additional available services.
Well, Krista, we actually have detailed list of services on our website. So if you head over to our website, whether you're inquiring about solo 401k or checkbook IRA, under each one of those on our menu, you click on pricing, and that will have detailed description of the services that are included. So do that. I rather not take the time to read that. You can do it yourself, slowly digest it, and if you have any further questions, you can certainly reach out for further help.
Is asking, do investments in LLCs by sole 401k need to be appraised every year? And will the IRS respect the valuation if the LLC manager does it?
Robert, if you have a solo 401k and if the total plan assets are exceed $250,000, then you need to submit annual Form 5500 EZ, which will ask for you to specify the total plan assets in the beginning of the year and in the end of the year. And for those purposes, you can use the manager's valuation, because it's just you gotta report it. It's not a taxable event. If there is a taxable event, then you will need a third-party valuation company to do the service or an appraisal to specify that, because it's a taxable event. So you need a more formal valuation in that case.
Judith is asking, how do I get my investment single-family house out of the 401k? Will that create a taxable event? If so, is there any way to avoid or minimize the tax?
Oh, Judith, good question. If you own a single-family investment property in a solo 401k, it is possible to pull that out, and the term for that is in-kind distribution. So rather than taking the cash out of the 401k, you can pull the asset out. In contrast to the previous question, you have to get the property appraised, because it is a taxable event. And the appraised value will be the taxable amount. If you do it before normal retirement age, you will have to pay the penalties on top of the taxes, but it will be a taxable event. Now, if your Roth 401k owns the property, then if you meet the criteria, it will not be taxable, it will be tax-free. So that's a possibility. I'm not sure if it makes sense to pull the property out of for Roth 401k though, because it's tax-free, and then you can have a tax-free income stream for the rest of your life. But it is possible. Well, is there anything to minimize that? It's really a question to your CPA. You have to come up with a tax strategy. There might be things to offset your tax liability. If you pull in a property, that can be a large liability. So there might be some things that you can do somewhere else on your tax planning platform, if you will. But as far as the 401k, again, the distribution is taxable event if it's pre-tax. One thing that you can do is you can actually convert it to a Roth. So the conversion will be taxable event, but then future distributions will be tax-free. So that's, and you can do partial conversion too. You don't have to convert the entire property at once, in stages. Again, it's a tax strategy. You got to get your CPA involved. Perhaps there is a year that is low income for you. That might be the year when you want to do a Roth conversion. But other than that, again, you got to plan this with your CPA.
Judith would also like to ask, can you explain a land contract and advise if it would be applicable to use in this instance?
The instance you're referring to, I believe, is taking the property out. Well, when you take the property out, I don't believe you can use a land contract. This is probably, again, you need to talk to your CPA and attorney. A land contract is basically a seller financing. So you can sell the property using a land contract, and so basically you carry the mortgage, but you can't sell it to yourself. So it's not going to work because this is not a sale, it's a distribution. So land contract can work. You can use it with the solo 401k, whether you're selling the property or actually acquiring the property. It can work both ways. But the other party cannot be disqualified person. So you can sell it to yourself. The only way to pull the property out of a 401k is by taking in-kind distribution.
Next question is from Carolina. She's asking, if real property is part of my solo 401k portfolio, how do I go about selling it without triggering a tax event?
Well, if your retirement account owns a property, it's basically the same as your IRA or 401k owns a stock and you sell it. And you have gains on that investment, but those gains will not be taxable because they're inside of a tax-deferred retirement vehicle. Now, one thing to keep in mind is that if you do have a self-directed IRA and there is a leverage on the property, then UBIT will apply. There will be some unrelated business income tax implications because there is a leverage. But as long as you pay off the leverage and you sell the property that is free and clear, you should not have any tax implications, regardless whether it's an IRA or 401k.
He's also asking, what are the logistics of sale proceeds going to solo 401k tax-deferred bank accounts?
Well, the sale proceeds will be sent to the owner. So if you're selling a property, let's say in a 401k, your 401k is the owner of the property. There'll be escrow title company involved, the third party that handles the transaction. So the sale proceeds from the buyer will go to escrow, and then escrow will distribute those proceeds to the seller. The seller in this case is a solo 401k. So typically you will provide the escrow company with the bank information for your solo 401k, and that's where they distribute the funds. You cannot touch those funds yourself. They cannot go to your personal bank account because, again, you're not the owner of the property. The 401k is.
Tony is asking, what specific plan language is required to preserve the checkbook control while avoiding prohibited transaction risk when investing in real estate or private deals?
Well, Tony, the way to avoid the prohibited transaction is to follow the IRS rules. We touched on that earlier today with the previous question, is that you need to understand a prohibited transaction and the investments that are disallowed, and then disqualified person. So your retirement account cannot get engaged in any transaction with disqualified person. So as long as you keep all the transactions arm's length, you'll be fine.
Tony would also like to know, where is the precise line between acceptable involvement and prohibited self-dealing if I'm active in sourcing, structuring, or operating investments?
Well, Tony, again, in this case, you got to be careful. I probably need to talk to you to specifically answer the question here. you're mentioning sourcing, structuring, and operating investments. Remember that you're a disqualified person to your solo 401k or checkbook IRA. So while you do have control, you're limited on what you can do. You're only allowed to provide basic administrative functions for your retirement account. So you can cross that line if you're providing services. So I suggest you go to our website and schedule a consultation with one of our retirement account experts, and then we can discuss specific situation that involves you and help you understand whether it's allowable or not.
He's also asking, how do you evaluate when non-recourse leverage inside a solo 401k is actually worth the UDFI tax drag?
Tony, there is no UDFI tax implications with the solo 401k. That only applies with the self-directed IRA. Whether or not it makes sense, I'm probably not the right person to help you with that. Again, you got to kind of crunch the numbers and maybe talk to your CPA. But generally speaking, you're using leverage. So yeah, there might be some tax implications, but you're actually receiving you're using somebody else's money. So in my opinion, it still does make sense.
Also like to know what solo 401k structures appear compliant on paper but fall under real-world execution or IRS scrutiny.
I can give you a specific example, Tony, but generally speaking, just in my experience talking to my clients for the last 15 years, is that a transaction that involves disqualified person. So you want to avoid that. Let me give you an example. I talked to a client just a couple days ago who is he's in commercial real estate, and he was considering doing a transaction, buying a commercial property jointly with his 401k. So he personally will own a portion of the investment, and his 401k will own a portion of the investment. And while it could be structured to be okay to begin with, but because of the disqualified person's involvement, it can lead to a prohibited transaction. So I did not recommend that to him. I recommended keep it arm's length, your 401k from yourself. So that's just one example.
Tony would also like to know if you were building the solo 401k for yourself to compound aggressively while preserving long-term optionality, what would you do differently than most of the off-shelf plans?
Tony, it looks like you are you're not a client. Looks like you don't have a solo 401k yet. So if the question is to us what Sense Financial will do differently, again, let me explain you that we are not involved in your investments. We provide you with the vehicle, and the difference of what we offer comparing to other alternatives for the solo 401k that you have out there is that we do give you the ability to invest in alternative assets. While you can go to Fidelity or Schwab and open a solo 401k there, this 401k plan will not have the ability to invest in alternative assets. You're probably not going to have the ability to take a participant loan or make ROT contributions. So we offer open architecture for 401k plan that does not have investment limitations. So that's the main difference.
Next question is from a different Tony. How to roll over into another plan tax-free?
Tony, as long as you do a direct rollover from one qualified retirement plan to another, it's not a taxable event. So that's the key. You want to do a direct rollover. If you're moving from a solo 401k, there might be some limitations on the contributions. You may not be able to roll over some of the contributions. So check with us and we can guide you on this. But generally speaking, it's a direct rollover.
Our next question is from Snehal. How to set up an LLC under a 401k trust to hold real estate?
Good question, Snehal. You can establish an LLC to hold real estate inside of a self-directed solo 401k plan. Typically, that's not needed. You don't have to have LLC. Your 401k trust can own real estate directly, but if you want that for additional liability protection, then you need a special purpose LLC that is established according to, in to be in compliance with the IRS, reach out to our team. We can help you with this. So we can guide you how to set that up correctly.
Our last of the pre-submitted question is from John. I just retired and I'm still 6 years away from RMDs. However, I have gold and silver, which has significantly appreciated in my 401k as well as in real estate. I'm looking into developing a strategy to minimize the impact of RMDs when they hit.
Well, John, the key here is the planning. So you're about 6 years away from retirement, and the time to start planning is now, or maybe 5 years ago. So it's a hint for younger folks that you want to be thinking about this, because yes, you will get to the RMD age sooner or later, and you got to create a strategy. As far as minimizing the tax impact, again, that's not really a question for me. What I can help you is, again, potentially doing ROT conversion, converting that to ROT, because ROT distributions are tax-free and ROT is not subject to RMD. But as far as the tax strategy, that's something that you got to discuss with your CPA, because regardless whether you have a self-directed solo 401k, self-directed IRA, or just regular IRA at Fidelity, the tax implications will be the same. And you do need to discuss that with a qualified tax advisor.
And that is all of our pre-submitted questions. I do notice that we have some questions from our live chat, and I'll be getting to them one by one.
Okay, let's get to it.
All right. One of the questions that we have on here: if I am buying an investment property that is a duplex, we will have the renters. The 401k is buying 50% and my mother is paying 50%. Is that allowed?
Well, again, that's one of those questions. I talked about this in my answer to a previous question, where your 401k is buying jointly with a disqualified person. Your mother is a disqualified person. So while technically it can be structured to be in compliance, a transaction like this that involves disqualified person may lead to a prohibited transaction. It might not be prohibited to begin with, but because of the disqualified person, and we don't know what might happen in the future, it can possibly lead to a prohibited transaction. So I would advise not to do that. Just use your 401k money. There's plenty of opportunities out there to make the investment. If you need to partner with someone who's not a disqualified. But this is just, I rather err on the conservative side than being risky, and that will lead to a prohibited transaction. I want you to avoid that.
Is asking, I moved from discount Self-401k. Do I need to redo any paperwork, including beneficiary documents?
If you moved from another plan provider, then the beneficiary designation should have been done when the plan was established originally. So if you never completed beneficiary designation form, then you should. We can provide you with the form. If you cannot find it in your records, you should do that. But as far as the documents, yeah, if you completed the onboarding process, then our team will contact you with the next step. If you have not completed the onboarding process, then you definitely should do that. So to ensure that your plan is IRS compliant.
Is asking, for solo 401k investments in LLCs, is it okay to use K1 as appraised value at year end?
If you're investing in an LLC and you got a K1, yeah, you should be able to use the value provided on the K1 to you at the end of the year as a value for that particular investment, and you can use that on a Form 5500 when you calculate total plan assets.
Next question is from Judith. Can I loan the solo 401k money so I can take my RMDs? My 401k is invested in a single family home and is not liquid.
I'm not sure I understand the question. Can I loan the money from the 401k? So if you can specify that, if you don't have enough liquid cash in the 401k to take the RMD, you still have to take the RMD. So the possible solution might be that you take in-kind distribution. You can either distribute the entire property, we talked about this, or potentially a portion of the property. You can distribute that from your 401k to yourself, but you have to satisfy the RMD because penalties are too steep for not doing that. And again, you don't want to wait until you're 73 to deal with this or just to think about this. You want to think about this way ahead. Again, a hint to those who are listening, you want to be thinking about this ahead of time. Ideally, when you approach the RMD, you should have enough assets that produce enough passive income to satisfy the RMD, or at least you have to have some assets that are liquid, that you can take the income from those assets and satisfy the RMD. But if you fail to do that, you're going to have to do alternative, which is in-kind distribution.
He is asking, is it prohibited to have my sole 401k invest as an LP into multifamily LLCs that I am 40% owner of that invest in multifamily properties?
Yes, that would probably lead to a prohibited transaction without digging further, because you are personally a general member, my understanding, in those partnerships. And by having your retirement account investing into that partnership, you will receive indirect benefit, which is prohibited.
Jose is asking, once I download the forms on the portal to change beneficiaries, how do I properly execute the change in beneficiaries to make sure it's done correctly? And does it require a notary? Also, do you help with this service, or what is your fee to review a plan to make sure that it is properly executed and in compliance?
If you're a client, there is no fee for this service. If you're not a client, we don't offer this service, so we only help our clients. But to execute beneficiary designation, it does not need a notary if your spouse is the primary beneficiary. If you designate someone else other than your spouse as a primary beneficiary, then the form needs to be notarized. We recommend you keep the original in your records and send a copy to us as a backup.
Question is from Muhammad. I have a solo 401k. Do I have to buy the solo 401k, or can I have a different LLC on the name of title on the property?
You can do either or. You don't need to have LLC to buy a property in your solo 401k. Solo 401k can buy and own a property directly in the 401k trust. But if you wanted to use the LLC, you probably need to create separate LLC for each property. If you want to have the true separation, it needs to be set up in a certain manner so it will be IRS compliant. Reach out to our office and we can help you with this.
He's also asking, what is special purpose LLC?
A special purpose LLC is an LLC that is created specifically to be owned by your IRA or 401k. It's not, you can't do that just going on Zoom or some other services online. It needs to be compliant with the IRS, to have a certain IRS language, outline prohibited transactions. So that's what it means.
All right. Those are all of the questions that I see on my end. Is there anything that you would like to add, Dmitry?
Good questions. I enjoyed answering them, and thanks for your help today, Leah, and we look forward to seeing you again during our next Q&A, which is going to be, do you have the date for that, Leah?
It will be the first Monday of the next month. Let me just double check there. It should be on the 2nd.
Typically first and third Monday, and the date is again?
It will be the 2nd of February. All right. Thank you, everyone.